Hello and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today it's Friday, so happy Friday first of all. I hope you had a fantastic week. And Friday also meets Fundamentals Friday at DDI. And on Fundamentals Friday, we typically pick one key topic that we are talking about, typically a headline out of the news or something like that. Today, and let me quickly share my screen to make it easier for you to follow a little bit. Today, it's Transpacific volumes. We had a lot of discussion over the past couple of weeks, months about the supply-demand imbalance. We still maintain the notion that supply vastly outstrips demand, especially over 2024 and the beginning of 2025, because there's just so much capacity on the order books and scrapping volumes are just not there, haven't picked up yet, and it's also questionable whether enough capacity could be scrapped in such a short amount of time. But now some positive news or some light at the end of the tunnel, at the horizon, so to speak, comes from Transpacific. And there's two main sources for that. One is Madsen, sort of the Honolulu-based Transpacific specialist, so to speak, has reported solid freight demand despite a muted peak season in Q3. The Q3 results will be published on Monday, but Madsen already says it expects net profit for the period to be in the range of 140 million to 120 million US dollar, compared with 266 million versus Q3 2022. So still relatively positive result, just a 50% decrease in net profits. And that's driven by that demand uptake. Another source is here, Mr. Siroka, which is the port chief of the LA Long Beach port complex, says, hey, this labor deal ratification, remember we talked a lot about the labor dispute at the US West Coast ports, has really boosted imports into LA and Long Beach ports. September has really been 8.7% above the same period in 2022 and even 6.1% above 2019, which is sort of the pre-pandemic reference point, which is still sort of unencumbered by that significant swings in cargo volume. So this is very, very good news. A main driver here is seen as consumer spending in the US is very resilient despite sort of inflationary pressures, high interest rates, and economic uncertainty. So there's quite a bit of resilience there. And also Mr. Siroka reports, hey, inventory to sales ratios, we see that actually sort of on pre-pandemic levels now between 1 and 1.3. Of course, we'd have to look into the details into what kind of categories this applies to, but that is quite a positive news item, because that means that retailers and wholesalers have been able to reduce their inventory levels to match sort of spending behaviors and consumer spending patterns. And that means that every uptick in consumer spending now actually sort of immediately feeds through to cargo demand, because there's not a lot of dead weight on the inventories here. Last bullet point here, there has been some shift away from China in line with this China +1 or actually no China policy in some cases, but actually more than 50%, 53% to be exact, of the imports into LALB, Los Angeles and Long Beach, in the first 9 months of 2023 have been from China versus 57% in 2022. So yes, there is some shift there, but not really significant. Again, here, this data point and this bullet point comes from Mr. Siroka, the LA Long Beach port chief. So what does this mean for you, for us? Well, first of all, Transpacific is alive and kicking, so that's good. What that means for global demand, TBD, because there's dark clouds, of course, all over Europe and Germany specifically. Recessions, very negative consumer and business sentiment. So not a lot of hope for a demand uptake or recovery there. That's it from me, from us for today. Thanks a lot for tuning in, and have a fantastic week, and talk to you all on Monday. Bye-bye.